Welcome back to the Daily Crypto Deep Dive. Today, we are tackling a question that goes right to the heart of the entire Bitcoin thesis. Is Bitcoin actually a safe haven? Or is it just another high beta risk asset that sells off the moment missiles start flying? Because over the last few days, as geopolitical tensions escalated in the Middle East, we saw something fascinating. Oil spiked, gold caught a bid, equities wobbled, and Bitcoin moved violently, but not in the clean, textbook, flight-to-safety way many long-term holders would expect. So today, we are not doing surface-level price commentary. We are dissecting market structure, capital flows, institutional behavior, and on-chain activity to understand what really happened, and what it tells us about Bitcoin's evolving identity. And if you're holding Bitcoin, Ethereum, XRP, Solana, or Cardano right now, this matters more than any short-term price candle. Let's start with where the safe haven narrative even came from. Bitcoin was born out of the 2008 financial crisis. Embedded in its genesis block is a headline referencing bank bailouts. From day one, it was positioned as a sovereign neutral asset. No central bank. No political control. A fixed supply of 21 million coins. Censorship resistant. Borderless, permissionless. For over a decade, that thesis quietly built credibility. During capital controls in places like Cyprus, during currency collapses in Venezuela, during sanctions and banking restrictions in Russia, during the early stages of the Ukraine conflict when traditional banking rails were disrupted. In each of those moments, Bitcoin functioned not as a price-stable hedge like gold, but as a capital mobility tool. That distinction is critical. Gold protects purchasing power slowly. Bitcoin allows you to move purchasing power instantly. Those are not the same thing. Fast forward to 2020. Central banks inject trillions in liquidity. Inflation spikes globally in 2021 and 2022. The digital gold narrative resurfaces with force. Institutional investors begin allocating. Hedge funds treat Bitcoin as a macro asset. Corporations add it to balance sheets. Eventually, spot ETFs launch, bringing regulated exposure to pensions, advisors, and asset managers. At that moment, Bitcoin changes structurally. Because once institutions enter, Bitcoin is no longer just a rebellion against the system, it becomes part of the system. And that is where the tension begins. When the recent airstrikes occurred, traditional equity markets were either closed or illiquid. Gold was trading in limited sessions. Oil futures reacted sharply when they opened, but crypto was already trading, fully liquid, globally accessible. Bitcoin became the only real-time price discovery engine for geopolitical risk. And what did it do? Initially, it sold off. That knee-jerk reaction surprised many who still cling to the digital gold framing. But when you zoom out and think like a macro portfolio manager, it makes perfect sense. When geopolitical risk spikes, institutions de-risk first and ask questions later. They cut exposure to high-volatility assets. They reduce leverage. They trim positions that can move quickly against them. And Bitcoin, for all its philosophical narrative, is still one of the most volatile large-cap assets in the world. So the first move was mechanical. Risk reduction. That does not invalidate the long-term hedge thesis. It simply reflects how Bitcoin is currently owned. Because ownership structure matters. A decade ago, Bitcoin holders were mostly retail investors and early adopters. Today, a significant portion of supply is held through ETFs, custodial products, and institutional vehicles. Macro funds traded alongside tech stocks. Quant desks arbitrage it against NASDAQ futures. Prop traders use it as a liquidity proxy. When they receive a geopolitical shock headline, their models do not ask, "Is this digital gold?" Their models ask, "What is my highest beta exposure?" And Bitcoin scores high on that list. But here's where the story becomes more nuanced. After the initial volatility, on-chain data began to tell a different narrative. In times of crisis, exchange inflows typically spike. That suggests holders are preparing to sell. Stablecoin demand often rises, signaling a rush into dollar-denominated safety. In sanctioned or conflict-adjacent regions, Local crypto activity often increases sharply as individuals seek to move capital outside traditional banking rails. And that's exactly what we saw. Reports indicated sharp increases in regional crypto outflows shortly after escalation. That behavior does not reflect speculative trading. It reflects capital flight. That is safe haven behavior, just not in the way traditional gold investors think about it. Gold does not spike because Venezuelans are trying to wire money internationally at 2 a.m. Bitcoin does. Gold does not process billions in value transfer on a Sunday night during a banking freeze. Bitcoin does. So the question becomes more sophisticated than did price go up or down? The real question is, what function did the network serve? And during this crisis, the Bitcoin network functioned exactly as designed, as a censorship-resistant, globally accessible settlement layer. Price volatility is a side effect of liquidity, not a verdict on purpose. Now let's compare this to gold directly, because this comparison is often made too simplistically. Gold trades during market hours. It is deeply liquid, but not 24/7 in the same way crypto is. Its volatility profile is lower. It moves gradually in response to macro shifts. When geopolitical risk rises, gold tends to grind higher as institutional allocations increase incrementally. Bitcoin trades 24/7. That means it processes information immediately. When missiles launch, it reprices in seconds. When fear spikes, it moves violently. When clarity returns, it can rebound just as quickly. So when critics say Bitcoin is too volatile to be a safe haven, what they are often observing is not weakness, but transparency. It is a fully transparent, continuous market. Volatility is not the opposite of safety. It is often the price of liquidity. But we cannot ignore the correlation question. Over the past several years, Bitcoin has shown increasing correlation with risk assets during acute liquidity stress, during rapid rate hikes, during equity drawdowns, during ETF outflows. That correlation tells us that in the short term, Bitcoin behaves like a high beta tech stock. That's regime 1. However, there is evidence of regime 2 emerging. In multiple recent macro events, Bitcoin initially sold off alongside equities, but recovered faster once fear stabilized. That pattern suggests Bitcoin is evolving into what we might call a liquidity hedge. It dumps when leverage unwinds, then rebounds as capital seeks alternative rails. That is very different from being a permanent risk asset. Now, zooming out further, we must consider sovereign dynamics. As geopolitical tensions increase globally, capital controls become more likely. Sanctions expand. Banking access becomes politicized. In that world, Bitcoin's censorship resistance becomes more valuable. That would be regime 3, a sovereign hedge regime. We are not fully there yet, but every geopolitical shock pushes the conversation further in that direction. So where are we today? We are in transition. Bitcoin is no longer a fringe cypherpunk experiment. It is institutionalized. That institutionalization increases short-term correlation with risk assets. But at the same time, its core utility as a capital mobility tool becomes more visible during crises. The market is struggling to price both identities at once, and that tension creates volatility. For serious investors, the takeaway is this. You cannot judge Bitcoin's safe haven credentials solely by the first hourly candle after a strike headline. You must examine ownership structure, liquidity mechanics, and on-chain usage. If the network is processing heightened activity during stress, if capital flight behavior increases, if stablecoin rails expand, then Bitcoin's utility is strengthening, even if price is unstable. And that may ultimately matter more. Now, before we close, I want to anchor this in practical terms. If you're holding long-term, understand that short-term correlation spikes do not necessarily break the macro thesis. If you're trading short-term, understand that geopolitical volatility will likely continue to produce sharp, fast repricing events in crypto before traditional markets even open. Bitcoin is now the fastest macro barometer in the world. It moves first. And that comes with both risk and opportunity. We are not in a simple digital gold world. We are in a complex transition phase where Bitcoin is part risk asset, part liquidity hedge, part sovereign alternative. That complexity is not weakness, it is maturation. And as always, if you're serious about holding long-term, make sure you're securing your assets properly. Self-custody matters. Hardware wallets matter. Counterparty risk becomes more visible during geopolitical instability. Drop your thoughts in the comments. Is Bitcoin digital gold, or something entirely new? Smash like, follow the show if you haven't already, and we will see you at the top.